Welcome back, investors. Thanks for joining in. Today we'll be looking at CVS. This company has seen weak performance in share price over the past years, but lately we've seen a bit more price action to the upside. Today CVS reported their Q4 earnings, which came in above expectations. They beat on EPS by 13 cents a share, a 6% increase year over year, and revenue numbers looked good as well, with a 12% year over year growth. To get a broader insight into the financial performance over the past years, we'll be hopping over to QuantView, our stock insight tool. Here we see a solid uptrend in revenue numbers, which hasn't been interrupted. Free cash flow numbers peaked in 2021 and has dropped since to 2019 levels, giving us an idea why the current share price might be lower. EPS and net income have grown ever so slightly every year, with some years being lower. Long-term debt increased significantly in 2018, it being 3 times higher than the year prior. They have managed to increase their cash pile since then though, while reducing long-term debt, which is a good development. Now that we have a general idea of how CVS has been performing, let's zoom into some of these metrics to see if CVS fits our preferences when valuing a stock. We'll be performing our valuation in 3 steps. First is the margin of safety. In this segment, we'll be assessing CVS's key metrics and ratios to determine if we should be more or less cautious when determining our fair value. In the second step, we'll be performing various valuation models to see what the intrinsic value is of the company based on different metrics. And lastly, we'll combine the 2 steps to give us a fair value of the company. To determine this final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 30% that can never go below 0%. The margin of safety can either increase or decrease based on the metrics that we'll be looking at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we are using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be looking at revolve around growth. Here we look at the earnings per share growth and the free cash flow per share growth. Over the years, CVS has managed to grow their EPS going from $3.80 a share to $6.09 a share. We'll only be looking at the past 5 years though, and during this period, the growth rate is just over 5%, meaning no change in the margin of safety. We also have the free cash flow per share growth, which, like we saw earlier, has put in its peak in 2021. In the past 5 years, the average growth rate here was 7.65%, meaning once again no change in the margin of safety on this metric. Next up, we have the financial health, where we'll be looking at the debt to EBITDA and the Altman Z-score. Debt to EBITDA is calculated by taking the debt of the company, subtracting the cash from it, and dividing it by the EBITDA, giving us the amount of years of EBITDA needed to repay all debt. For CVS, this is sitting at 302%, which is ever so slightly higher than the 300% maximum that we want to see. This means a 5% increase in the margin of safety. The Altman Z-score is a ratio used to predict whether a company is likely to go bankrupt or not. It is formed by using a bunch of different metrics like working capital, total assets, market cap, and sales. When a company scores lower than 1.8, it has a high chance of going bankrupt, while a score of 3 means a score of 3 and higher means that it is very safe. CVS scores right between these two with a score of 2.2, meaning that there might be concerns about the financial health, but that it is still relatively safe. The next segment is focused on us, the shareholders. What is the company doing to reward us if we hold this stock? Well, we can see that over the years CVS has done some good dividend increases, making their dividends per share go from $1.10 to $2.37 in 2023. An average growth rate of 11%, deducting 10% from a margin of safety. In terms of share buybacks and dilution, CVS has done buybacks from 2014 to 2018, but issued many shares in 2019, causing the share count to go up by almost 25%. This means that over the past 10 years, shareholders have been diluted by just over 13%, which means a 5% increase in the margin of safety. And lastly, we have the capital allocation metrics, where we'll be checking out the return on equity and the return on invested capital. This first ratio that is calculated by taking the net profit and dividing it by the equity is sitting at 12%, which falls exactly in the green part of the scale, indicating a 5% deduction from a margin of safety. Besides this, we have the return on invested capital, which is calculated by taking the EBIT, tax rate, and the invested capital. This ratio gives us an idea how effective the management is at allocating capital. For CVS, this ratio is sitting at 6%, which is lower than we would like to see in a company. Since it's not that low either, we won't adjust our margin of safety with this ratio. Now that we've gone through all of the metrics, let's go look at the valuation models next to determine the intrinsic value of CVS. The first valuation model that we'll be using is the discounted cash flow model. As you can see, the free cash flow has gone up significantly over the years for CVS, going from $6.2 billion in 2015 to $13.5 billion in 2023. The average growth rate, therefore, is sitting at just above 12%. And we'll be laying out 3 cases to determine our valuation in this model: a normal case, a best case scenario, and a worst case scenario. In our normal case, we have a short-term growth rate of 5% and a long-term growth rate of 3%, and a weighted average cost of capital of 9%, and a perpetual growth rate of 3%, that we'll be using in the other cases as well. In the best case scenario, we have a short-term growth rate of 10% and a long-term growth rate of 5%, and in the worst case scenario, we have a short-term growth rate of 3% and a long-term growth rate of 0%. Weighing all of these together, we get a sum of free cash flows of $249 billion. And then to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $194 billion. Dividing this by the amount of shares outstanding, we get an intrinsic value of $151. And with the current price of $76, this is a 100% upside from the current price. The second model that we'll be using is the dividend discount model. I've imported all of the annual dividends going from 2013 to 2023, and the average growth rate in the dividends has been sitting at almost 11%. We've once again laid out a base case for this scenario as well, which we have a short-term growth rate of 7% and a long-term growth rate of 5% in the dividends. And we once again have the 9% weighted average cost of capital. And if we take the present value of all the future dividend payments, we get a sum of $76, which is exactly the current price, meaning that based on this model, it is trading around the fair value. Next up, we have Graham's valuation formula. Here we'll be looking at the earnings per share that CVS is generating, the long-term growth rate projected by analysts, and the current yield of AAA corporate bonds. And we go by the theory of Benjamin Graham that the P/E ratio of a company that is not growing at all should be no higher than 8.5. And looking at all of these metrics, we get an intrinsic value of this model of $56, which is a downside of over 26%. The fourth model that we'll be using is the multiple valuation, where we'll be looking at similar companies to CVS and be looking at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 19.63. All that's left to do then is to multiply it by the earnings per share that CVS is generating, which is $6.63 a share, giving us an intrinsic value of $130, which is 72% above the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years, and on average it has been sitting at 3%, while the current dividend yield stands at 3.61%, indicating that it's undervalued on this metric. Doing the same with the PE ratio, on average in the past 5 years it has been sitting at just over 14, while the current PE ratio is sitting at 11.4, meaning that it's currently undervalued on this metric as well. This is a mean deviation of 18%, giving us an intrinsic value of $89. Now that we've gone through all of the valuation models, let's look at the final overview of a valuation next. Coming to our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $100. A margin of safety we have determined earlier using a standard margin of safety of 30%, adding 5% for the debt to EBITDA and the share dilution, and deducting by 10% for the dividend growth and 5% for return on equity, giving us a margin of safety of 25%. Applying this margin of safety, we get an intrinsic value of $75, and with the current price of $76, it means that it is currently trading around its fair value based on our valuation. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And if you want to get access to all of the valuation models that we use in our videos and our stock insight tool, make sure to check in the description for our Patreon link. And thank you for watching.